US markets, Shrug at Nvidia, the importance of the US-India trade deal, and my take on meta platforms. This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode 146 of the Stock Doctor podcast. Now, a lot of things have changed in the market. On the last episode, I told you that market action about 2 weeks back, markets went down, then came back up, essentially ending flat for the week. There was no direction. You could have completely missed the market action and nothing, you would have and realized and switched on your portfolio on Monday morning, it would have remained the same. Last week, completely different picture. Okay, in the week gone by, completely different picture. We got a very clear, decisive market direction, and it was bad. And I'm talking real bad. It was really, really bad, very bad. And not even Nvidia and Godfather Jensen could save this market in the week gone by. On a week that saw the wildest intraday swing in recent memory, more on that later, Wall Street posted its worst week since early October. Once the dust had settled, all three indices firmly ended in the red, with the Dow closing down 1.9%, S&P 500 down 2%, and the tech-heavy Nasdaq, because of more pummeling that Nvidia received, closing down 2.7%. So it was clear market direction was there, and it was down. It was a market that was driven by sell-off as investors got very, very jittery. So let me welcome you to the first segment of this weekly snapshot and explain to you why investors became jittery, and take you through all the key developments of the week as always. And the week, unsurprisingly, was headlined by semiconductor giant Nvidia. I did tell you this towards the end of the close of the previous episode that it'll be all about Nvidia, and boy, was it all about Nvidia. I mean, this is a stock that's now 8% of the S&P 500. So a market move in Nvidia means pretty much the market direction. You've heard me wax lyrical about Nvidia on multiple occasions, so much so you could always say that I'm biased towards it, but not particularly. I've always waxed lyricals based on facts, and I didn't wax lyricals because I'm invested in the name, not because CEO Jensen Huang, in my view, is a visionary. None of that sort. The only reason why I keep praising Nvidia is the fact that the company just keeps delivering earnings growth quarter after quarter after quarter, and the growth rate of Nvidia's earnings pretty much defies gravity. Q3 was no different. Now, I'll be doing a very detailed Dr. Dissects on Nvidia in the coming weeks. You know this. But just to give you some context as to why I say Q3 was no different, continued to defy gravity. Q3 numbers overall, once again, brilliant. That's all pretty much, if I have to sum it all up. It was just brilliant, smashing any expectations, all expectations, the whisper number, as they call it, Wall Street official estimates, company's own estimates. Everything was smashed, and nothing was left, no stone was left unturned when it comes to growth trajectory. For the period ending October 26, which is the Q3, Jensen Huang-led company said it earned $1.30 per share as revenue soared 62% year over year to get this $57.01 billion. $57.01 billion in one quarter. Now, analysts are expected company to earn $1.26, so clear beat on EPS, and $55.2 billion in revenue, massive beat on revenues. Data center revenue, which pretty much makes up about 90% of Nvidia's overall revenue, jumped 66% year over year, coming in at $51.2 billion, smashing Wall Street estimates of $49.3 billion. Adjusted gross margins, something that companies look forward because they keep spending. So gross margins, would take a hit, but the company did promise us. Remember, the company at the Q2 guidance did promise that it would come in the mid to high 70s. It's exactly what happened, as it came in at 73.6% for the quarter. No mean feat for a company that keeps spending to grow. The guidance is equally strong for Q4. Nvidia now expects to generate $65 billion. That's an $8 billion pop. From Q on a sequential basis, plus or minus 12%, plus or minus 2%, sorry. And analyst estimate for Q4 guidance is $61.9 billion. That's a $3 billion already up. Non-GAAP gross margins are now expected to be 75%, plus or minus 50 basis points. Like I said, these are staggering, mouth-watering numbers, and more importantly, they were numbers that dispelled any notion that the AI bubble is about to burst anytime soon. I also want to mention that Nvidia's numbers and guidance didn't include any sales from China, which just demonstrates how much of a growth machine the semiconductor giant is. Now, you would think, I've given Vax Lyricals again, gave you the numbers, backed it up by facts. You would think, hallelujah, happy days in the market, right? Happy days in the market. This thing is going to pop back to the 5 trillion figure easily. Investors should have all the reasons to be very happy about, double-digit increase maybe because it smashed all expectations. You would think all of this would happen. So you think that what a week it's going to be for the markets, right? Unfortunately, while Nvidia's numbers should have got the AI trade back on track, it simply didn't. In fact, the reaction to Nvidia's numbers was clear demonstration of how much fear there is in the market with respect to the so-called AI bubble deflating. To give you some more context, the day after Nvidia reported, markets saw the largest blown gain since April 2025 tariff fuel market turmoil. In other words, it started off green, started off very, everything that I told you, everything that I told you to expect happened initially, and then they gave it all up and then some, suggesting that the heightened sensitivity to both fundamental and sentiment-driven factors. More specifically, initially, NASDAQ jumped 2.6%. When the market closed, it was down 2%. That's 2.2%, which is a 4.8% intraday swing. No mean feat. Yeah, 4.8% intraday swing. You would think about weekly gains of a single day, it went from 2.6 up to down 2.2% finish. S&P 500 jumped initially 1.9%. At the end of market close, down 1.6%. That's a 3.5% swing. 3.5% intraday swing. And finally, the Dow jumped 700 points initially, but actually closed down 387 points. That's a swing of more than 1,000 points. Just understand the magnitude of the swings. Yeah, it's not no mean feat for the thing to entirely. I mean, I've seen volatility, but boy, oh boy, is this some kind of volatility where you swing nearly 5% intraday, 1,000 points intraday. It's just absolutely madness at its best. Volatility at its finest, madness at its finest, chaos personified. As for Nvidia itself, the stock gained 5% initially, but ended down 3% for a company that just generated about 60% EPS growth. That's an 8% swing to the red. It's an 8% swing to the right. To the downside. Volatility is the name of the game. I feel like the podcast should call volatility is the name of the game for 2025. I'm sure you're sick and tired of me saying this once again. But on Thursday, I felt that there was so much chaos and fear that volatility simply became more than just the game. I mean, I've never seen anything like it. I mean, we had it in April, but kind of wild swings. And for what? Tariff-driven swings, I can understand. It was all negative news anyway, because the price, if those tariffs had still held today, the US economy would be in a lot more trouble than what it was. Inflation would be at, probably in persistent high levels. But this is on the back of a good news, on the back of an amazing numbers from the most valued company on the planet, from a company that has 8% S&P weights. And yet, you see these wild swings. That's just fear on steroids, essentially. So what could have led to these vicious swings? Obviously, you've got to analyze. The show is all about analyzing, right? Well, there are multiple factors, but thereby making it hard to pinpoint to a single factor. No surprises there. But in my opinion, it's because of a combination of the continued fears on AI investment bubble, as well as confusion and uncertainty surrounding the data, surrounding the odds of the Fed cutting rates at its meeting in December, which is about 3 weeks from now. Okay, which is a little over 2 weeks from now. Let me explain this context further to really understand the gist of things. Investors, after initially cheering Nvidia's numbers, are likely to have faced a harsh reality automatically. A sudden reality check, probably they would have realized, which is that if Nvidia is generating insane levels of revenue growth, that means it means that its customers, the hyperscalers and other tech names, are actually ramping up their spending even more, right? It's a zero-sum game. Somebody gets money in, some has to come out from somewhere. In other words, Nvidia's gains are a result of the continued spending by tech giants, which is the very reason why the AI trade unraveled. And when you add in the fact that spending by the big tech names has started to rely on large and complex debt deals, then it was only going to be a matter of time before panic and fear returned. Although I have to say, did not expect a 5% swing in NASDAQ. Simply did not. Now, at the same time, markets have also pretty much given up on a rate cut happening in December, adding more negativity. This is just fueling more negativity. On Thursday, we finally received the delayed September jobs report, which is as confusing as I find the unraveling of the AI trade. More specifically, while the US economy added 119,000 jobs, which beat estimates, the unemployment rate actually ticked up to 4.4% from 4.3%. So not only was the jobs report stale, but the metrics themselves were contradictory, adding more uncertainty. This is it just didn't add, it just didn't give any leeway for investors to celebrate Nvidia's awesome quarter, and it's only added more fear. To make matters worse, things just keep getting worse. I'm telling you. To make matters worse, Bureau of Labor Statistics, which publishes these jobs report and so on, announced that the October jobs report won't be released due to the government shutdown, which just reopened last week. And the November jobs report will only be released on December 18th. Small problem with this. The Fed meeting is on December 10th, which means, in other words, when you put it all together, the Fed goes into the December meeting with a stale contradictory report, which is not exactly reassuring for the markets when it comes to rate cuts. Long story short, the combination of the fears of AI bubble deflating, the so-called excessive spending by the big tech, and the fading hopes of a rate cut boosted the volatility and uncertainty, which led to these dramatic swings. The question then remains, are these swings justified? Are we panicking? Is there more fear is the fear indicator crazy? In my opinion, just like how markets were going up and away earlier in the year, and that was clearly overdone and at times illogical, the negativity surrounding right now is also overdone and to an extent illogical, in my opinion. In other words, irrationality should probably be the name of the game. Investor irrationality should probably be the name of the game. For Nvidia specifically, the sell-off created a disconnect between the company's valuation and the fundamentals. Moreover, management guidance of $500 billion plus, over 2 years, $500 billion plus in sales for the chips over 2 years, suggests multi-year visibility, not a speculative bubble. And the markets continue to underestimate the positive impact that sovereign AI can bring, which I find to be extremely confusing. And the current guidance doesn't even include any sales from China, a situation that is only likely to change in the coming months, which should mean that Nvidia's eventual numbers, should be much better than actually what's predicted. Now, are there risks to Nvidia and the AI? Of course, post-2026, the AI startups such as OpenAI, especially OpenAI, must generate cash flow to sustain spending. And this is the real test of AI sustainability. At the same time, I'm also not a fan of the so-called circular financing that Nvidia finds itself in. More specifically, here's what happens in circular financing. Nvidia invests in startups. These startups raise debt. Startups buy Nvidia chips. Revenue appears strong, but it's actually financially engineered, right? It's pretty much like, oh yeah, I'm going to give you the money and then you're going to give the money. Give me the money and then I'll give you chips. It's like a barter and a vicious in a circular. It's too confusing. Okay, it's too confusing as to, and this is clearly not sustaining. If you keep doing this financially engineered thing, it's just not happening long term. Okay, that's clearly, so there's this. But these risks to me are getting more weight than they deserve, especially when it comes to evaluating Nvidia. The semiconductor giant, make no mistake, is a growth machine. I am not just saying it, I'm giving you data and facts to back it. And Godfather Jensen continues to wave his magic wand to create growth amidst all this uncertainties. I have told this time and time again, you write off Jensen and Co. at your own peril. Q3 performance has only strengthened the conviction of this particular statement. As for the sentiment around the Fed and interest rates, the situation is a lot more trickier. I have to admit the situation is a lot more tricky, and that's because the Fed simply doesn't have any meaningful data to play with. And whatever data it has, which is the September jobs report, is stale and contradictory, not exactly an ideal situation for a central bank that prides itself on being data dependent. At the same time, there are also internal divisions within the Fed surrounding rate cuts, which is going to be a significant obstacle during the meeting. Fed Chair Jerome Powell faces the most resistance within the FOMC, Federal Open Markets Committee, for any rate decision in his 8-year tenure. And given that he leaves his position in May, he has only 4 more meetings left. It is highly likely that divisions could persist well into 2026. With consumer sentiment hovering near one of the lowest levels in recorded history due to inflation, the Fed has to find a perfect balance between reducing inflation while at the same time dealing with a labor market that is clearly showing signs of weakness. How they do this with no meaningful data is something, ladies and gentlemen, I simply don't have an answer for. And I have a feeling that neither do Powell and company. Long story short, While I would expect volatility to continue to persist into the year end, one thing's for sure, Nvidia shouldn't be the catalyst for that. If it is, then for me, that's just a screaming buying opportunity. On that note, let's head now to India. In our next segment, the doctor goes home. Now, I have told you a lot of times about how the domestic, the growth story in India has remained resilient and it continues to remain, growth story remains intact. But one thing's becoming a lot more clear, and last week data made it even more so clear, which is that the US-India trade deal announcement has to come out soon. Okay, that's the message that both markets and the key economic data that we received last week indicated. More specifically, latest data actually showed that India's trade deficit in October soared to a historic high of $41.7 billion, far above economists' expectations and the previous monthly records. This widening gap was driven by a steep decline in exports, a substantial rise in imports, and a sharp surge in gold imports. Now, exports dropped 11.8% year over year to 34.4 billion in October. Imports, on the other hand, surged 16% year over year to $76.1 billion. Like I said, the major culprit behind the surge in imports is gold. More specifically, gold imports came in at 14.72 billion, which is nearly a 300% surge year over year. The surprising scale of the trade deficit in October comes at a time when India's exports are weakened by global economic pressures, while domestic demand for key imports, including gold, remains strong or is rising. The deficit significantly exceeded both the previous month's figure as well as the market's expectations, signaling possible stress for the balance of payments and the currency stability if this trend particularly persists. Now, while this surprising surge in trade deficit has added pressure on policymakers to get the deal done with the US, another reason is the declining rupee, which fell to an all-time low of 89.34 on Friday amid heightened market concerns surrounding unresolved US-India trade tensions. US tariffs on Indian exports, in effect since late August, have added major headwinds, contributing directly to the rupee weakness. Ongoing uncertainties surrounding bilateral trade relations with the US continue to dampen market sentiment with no clear resolution in sight. To give you some further context, foreign portfolio investors, FPIs, have removed $16.5 billion from Indian equities so far in 2025, escalating downward pressure on the rupee and further weakening its standing compared to other Asian currencies. Now, the concerns due to continued uncertainty surrounding the US-India trade deal was also highlighted by RBI Governor Sanjay Malhotra. The governor at a lecture mentioned that a favorable trade deal would help relieve pressure on India's current account. He noted current trade imbalances are significantly driven by expectations around US tariffs and that developments will depend on the outcomes of these negotiations. Look, I've said time and time again that India shouldn't rush into a trade deal with the US. And I continue to maintain that stance. We simply shouldn't be doing negotiations with gunpoint. Right? It doesn't work that way, especially since the Indian economy remains resilient thanks to the likes of income tax cuts and the GST 2.0 reforms. But I have to admit, there is a certain urgency that has been added to announcing at least a phase one of the US trade deal, given this ballooning trade deficit. Now, if things normalize by November, if the trade picture normalizes by November, investors like you and I can breathe a sigh of relief for sure. But if the November trade deficit also shows significant widening and no deal with the US has been announced, not even a phase one, then I do expect markets to feel the heat. And needless to say, the rupee is expected to feel the heat further. The Indian economy continues to head in the right direction, a point that I've stressed upon week in, week out on the show. Should continue to be the fastest economy. India should continue to be the fastest growing economy in 2026. But that doesn't mean that policymakers and investors should continue to ignore the impact from the delay on concluding trade negotiations with the US. All I can say as I wrap up the segment is over to you, Commerce Secretary, Mr. Piyush Goyal. On that note, we're going to head to the final segment, Dr. Dissects, where yet another Mag 7 name goes under the microscope this week. After Microsoft last week, this week it's the turn of Facebook parent Meta Platforms, ticker symbol Meta. Now, Meta reported its Q3 earnings a couple of weeks back, and if it weren't for a one-time significant tax charge of $15.9 billion, Meta would have delivered yet another solid quarter. Q3 revenues came in at $51.2 billion, up 26% year over year, and beating analyst estimates by $1.8 billion. GAAP EPS came in at $1.05, down 83% year over year, and significantly missing analyst estimates by $5.62. But however, in this particular scenario, it is very important that for investors to note that without the $15.9 billion tax charge, EPS would have actually been $7.25. And it would have been up 20% year over year and would have beat analyst estimates by 58 cents. So context is important. Context is key. The company's operating margins declined by 300 basis points on account of significant higher expenses, coming in at 40%. Finally, the company generated $10.6 billion in free cash flow. Now, it was a strong guidance, in my view, from the company management, although the significant increases in expenses and capex investments seems to have spooked the markets, as reflected by the near 12% decline in the stock post earnings release, and stock has only continued to decline since then. It even came below $500. Came below $600, trading around $594 on 500. More specifically, Meta now expects Q4 revenues to be in the range between 56 and 59 billion. FY25 total expenses are expected to be in the range between 116 and 118 billion, which represents an increase from the previous guidance of a range between 114 and 118 billion. Capex projections were also raised, with investments expected to be in the range of 70 and 72 billion compared to the previous range of 65 and 72 billion. For 2026, management announced that capex dollar growth will be notably larger than 2025, and total expenses are expected to grow at a significant faster percentage rate than 2025. Finally, management also announced that going forward, the company's tax payments would see a significant reduction for the rest of 2025 and beyond. Now, coming on to the main takeaways, the main culprit behind Meta's post-earnings decline, in my view, post-earnings decline in the stock, in my view, is not higher capex spending, but rather the surge in R&D expenses, whose growth reached levels last seen in the third and fourth quarters of 2022. If you recall correctly, that was the time when CEO Mark Zuckerberg announced that he was pivoting the company's focus from social media ads, they were still the core business, to the metaverse. Remember the dreaded word metaverse, so much so it even rebranded from Facebook to Meta Platforms. The shift in focus, like I said, was such an extent, the company even renamed itself to Meta Platforms. Given that the most recent surge in R&D expenditure is similar to the initial metaverse days, I think the post-earnings sell-off in the stock makes some sense to me. However, the critical difference between then and now is that the sell-off is purely driven by investor psychology rather than company fundamentals. Back in the initial metaverse days, billions were being spent on a business that to this day has been predominantly loss-making. The Q3 R&D expenditure this time is towards boosting its AI ambitions, an area that, in my opinion, is very, very real and has a significant potential to generate significant growth. It is also a critical area where, as I mentioned the last time I talked about Meta, the company is already a winner. For instance, during the most recent earnings call, management mentioned that their ads business has seen strong revenue growth, largely due to improvements in the AI ranking system. This can be seen in the average revenue per person, or ARP metric, which witnessed its second highest year-over-year revenue growth in the last 11 quarters, which makes it last 3 years. At the same time, the company's AI tools are also allowing it to drive engagement. The company saw the number of daily active people in its family of apps reach 3.54 billion, clocking the highest year-over-year growth in the last, nearly 3 years. The company also launched its latest AI tool called Vibes, which has seen strong retention and strong increase in growth on a weekly basis. Threads is also seeing very strong user engagement as it continues to gain traction among its users, as it recently surpassed 150 million DAUs, or daily active users. Therefore, if you put it all together, it is not as if the AI investments the company has made so far are not generating growth. Unlike the metaverse investments, the AI investments are generating very strong revenue growth. And if it weren't for a one-time tax expense, EPS growth would actually have been in the double digits and would have actually been around 20% year-over-year growth, a no mean feat, which, given the fact the company continues to spend. Investors, in my view, should also take into account that the notably larger capex spending plan for 2026 is not set in stone. Neither are these figures confirmed. I have no doubt that 2026 capex spending will be higher than 2025, but management during the earnings call clearly mentioned that they're only at the beginning of their budget process for 2026. CFO Susan Lee also mentioned that on the capacity side, budgeting is a particularly dynamic process. In other words, nothing is concrete yet. These things can change, a point that was also stressed upon by CEO Mark Zuckerberg multiple times during his prepared remarks and even during analyst Q&A. Another reason for the post-earnings stock sell-off is that there were no AI model announcements from Meta. It also, in my opinion, put investors off, and Mr. Zuckerberg didn't put a specific timeline on when a new AI model or AI products would be introduced. Once again, this can be related to investor psychology surrounding the metaverse announcement, during which, apart from anecdotal evidence, there was nothing concrete at the time. I simply don't understand the market obsession with respect to AI product timelines. I simply don't. Meta has brought new products and new models in the market on a consistent basis. And I admit, while Llama 4 did face issues around the time of its launch, the company during the earnings call announced that Meta AI usage has continued to improve as the company improves the quality of Llama 4. At the same time, even Meta's Reality Labs is seeing an uptick in revenue growth, and the latest Meta Ray-Ban AI glasses sold out within 48 hours of its launch. Although losses at Reality Labs continue to pile up, without the AI tools embedded in these products, the situation, ladies and gentlemen, could have been a whole lot worse. Overall, Meta's post-earnings slump can be attributed more to investor psychology than company fundamentals. The company's plans to invest aggressively in both R&D and in Meta superintelligence labs have taken investors back to the metaverse days, a trip down memory lane, if you must say. Although the only difference this time around is that AI, unlike the metaverse, is already helping the company to deliver strong growth and strong engagement. The company, unlike the metaverse days, is one AI LLM or one AI product away from gaining investors' trust again. That, to me, is a much better situation compared to 3 years ago. Based on this rationale alone, the post-earnings sell-off in the stock is clearly overdone. What do the valuations say? Because it's time for meta valuation. I've already written the numbers, but I'm going to take you through the valuation process. Now, to calculate Meta's FY26 EPS, I deployed a regime switching linear trend model along with the lines of Markov switching framework. The model detects regime changes in Meta's earnings history with the help of a structural break detection. Model then fits an ARIMA model to the most recent regime. I'm not going to go into much technicals. That's pretty much the model details. To detect regime changes, data on Meta's quarterly EPS was obtained for 54 quarters, Q4 2011 to Q3 2025, from the Financial Modeling Prep API. And then a chow test was then performed to identify the exact quarter when the regime changed. When I say talk about regime change, it means the change in behavior of Meta's growth. The test identified the fourth quarter of 2019 as the regime changing quarter. And then the ARIMA was deployed on the most recent regime, which is Q4 2019 to Q3 2025. The model was validated using an out-of-sample validation. More specifically, I used the last 3 quarters of Meta as the testing sample to examine the accuracy of the MS ARIMA, of the Markov switching ARIMA model. The evaluation metrics include mean absolute error of $1.05, mean absolute error of $5, the root mean squared error, RMSE, of $1.11, mean absolute percentage error of 14.3%, which is actually it is similar to the industry benchmarks, and MAPE less than 15% suggests prediction accuracy is pretty good. And it also had a directional accuracy of 100%, which means the model accurately predicted the direction of the earnings growth and the EPS growth essentially. Now, the MS ARIMA this model was then used to forecast the EPS for 2026, and it came out with the following results. In Q1 of 2026, it expects $9.13. Q2 of 2026, it expects $9.65. Q3 2026, we hit $10.16, and Q4 2026, we hit $10.68. That's the model predictions. So the projected EPS based on MS ARIMA for 2026 will then be $39.62. There is a catch. It is not $39.62. Because what I did is, given the volatility in capex spending, given the volatility in R&D expenses, given the volatility towards the AI investments and so on, I performed a scenario analysis, given that even management and we all know that the earnings are likely to be volatile, at least for the foreseeable future. The three scenarios, along with that, the three scenarios that I used for the scenario analysis is, you have a base case which has a 50% probability, and the base case is very simple. AI infrastructure return on investment materializes, revenue growth continues to exceed expense growth. Then I had a bear case, which is a 10% decline in base case, 10% decline in EPS from the 10% decline for the base case EPS. Bear case is very simple. Management's investments results in further margin compression. Expense growth continues to exceed revenue growth. Straightforward. Then the worst case, which is essentially a 20% decline in EPS from the base case. It's very simple. Whatever the scenario in bear case, that plus a delay in significant AI monetization to well beyond 2027 and 2028. And that's a 20% decline from EPS projected 20% decline from bear case, and it has a 15% probability in my scenario analysis. So here we go. You have the base case with a 50% probability. It comes out to be 1981. That's basically 50% probability into the projected EPS. The bear case is a 35% probability. It comes out to be 1248. And then the worst case scenario has a 15% probability, comes to be 475. So the projected EPS is actually $37.04. According to Seeking Alpha, Meta currently trades at a forward price to earnings of 24.1. 24.1 into 37.04, you get a price target of $893, which, ladies and gentlemen, suggests a 50% upside from current levels. Now, does that mean that you go in and go all in into the name? No. While the upside from current levels remains significant, nearly 50%, the stock has completely lost its momentum, as evidenced by the short-term momentum grade of D+ on Seeking Alpha's momentum scale. D+ is not a good grade at all. You don't need me to tell you that further. As such, I am maintaining buy rating on the name rather than upgrading it to a strong buy. In other words, buy on any weakness, but you accumulate on any weakness. In other words, you do a dollar cost averaging is what I would suggest. Because the momentum is simply broken. Now, every time I give you a bull case thesis, I always talk about the risk factors. The primary risk factor to my bull case is if the AI investments and the R&D expenses do not pay off. In other words, any combination of the bear case scenario that I talked about and the worst case scenario that I talked about would be a significant headwind to the company's margins and growth. The other risk factor is the regulatory headwinds, especially in Europe, a point highlighted by the management during the earnings call. At the same time, management also highlighted that a number of youth-related trials that are scheduled for 2026 in the US may lead to some material loss. These regulatory headwinds won't just affect the margins and the bottom line, but also, if significant, could actually lead the company to scale down on its AI efforts, which is a strict no-no to my bull case. Bottom line, if it weren't for a one-time tax expense, Meta would have beaten both the top and bottom lines handsomely. Instead, it was a quarter where the company beat the top line but missed the bottom line estimates. In addition, the company's R&D expenses significantly increased, and the company also announced the capex investments are going to be notably larger in 2026 compared to 2025. These multitude of factors, given that they reminded investors of the days when the company pivoted to the metaverse, were more than enough to send the shares tumbling post an earnings release. In my view, the big difference between the company's metaverse pivot and the AI ambitions is that the AI ambitions is an investment that is already paying off for the company. And unlike the metaverse pivot, it is more likely to be a strong catalyst for the company's current and future growth. As such, the AI-related investments cannot be compared to the company's metaverse-related investments, which continue to lose money to this day, albeit the Ray-Ban Meta glasses do appear to be a turning point. From a valuation perspective, the model that I deploy suggests that the stock is significantly undervalued at current levels. However, given that the momentum in the stock is completely broken down, I'm maintaining my buy rating rather than upgrading it to a strong buy, despite nearly 50% upside from current levels. In my opinion, anytime there is a significant sell-off that is purely driven by investor psychology than company fundamentals, it is a buying opportunity. And therefore, Meta's case, ladies and gentlemen, is no different. That's all the time I have for you this week. If you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttamvinay, UTHAMBINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. I will see you next week. Until then, stay safe and make some money.